Welcome to a supplemental video update. This is being prepared May 29th, 2022, where I will address the topic, the fixation with the Fed. There's some assumptions that I'm making as I go into this video. The first one is market participants can profit from up, down, and sideways movements. I'm assuming that you already know that. If you don't, then this may not apply to you all that much. If you're just dollar cost averaging, or if you're a long-term investor and you don't get out, regardless of what's going on in the market, this may not apply to you, but it might still be helpful to try to understand what is going on. Simply going long exposes participants to unnecessary risk, and I teach about this in my classes. This does not allow for taking advantage of all market conditions, and you can make profits no matter what the market's doing. You just have to do the right thing at the right time. Short, intermediate, and long-term strategies are what you implement. I'm assuming that, typically at the same time. Another thing that I'm assuming is that you understand risk and you try to offset or even eliminate that by enacting a solid plan. And I teach that too, where you can't just jump in. You can't just go off what somebody else says. You have to develop a plan that works for you. Not only that covers what you do to get in, but how long are you going to stay in? What's your profit target? What's your goal in the future? You need to decide these things before you even get into a position. If you don't know that, you're pretty much flying blind. I'm also assuming that you practice hedging, whether you can eliminate either part of or all of the risk that you have to your portfolio. And there are ways that you can do that. The other thing I'm assuming is that you exercise proper trade and investment management. That means you're watching your investments. Some you may not watch all that closely because they're very long term. Others you need to really keep an eye on. I'm also assuming that you exercise prudent money management. And that really is what it comes down to in the end. That's why a lot of people just give up in dollar cost average, because they don't understand these other areas and they can still make a fairly decent return over a very long period of time by just dollar cost averaging. And that's okay. I understand that. But if you really want to go to the next level, it is imperative that you implement some of these other strategies and tactics that I've just mentioned here. Another thing that I'm assuming, which may not make any sense at all, is that the markets lead the news. We tend to think that the news leads the market. That's not always the case. In fact, that's rarely the case. Usually the market sets up, something happens, and then the market reacts to that in the way that it wants to react. All the statements in this video are intended to be taken at face value, just as I say them, without inserting any personal opinions or biases. I'll address that a little bit later, but it's very important to be neutral and open-minded. The scenario presented in this video will be added to what I call the possible positive scenarios. Every day I do a video, and if you're not familiar with those, I cover what are considered to be what are some longer-term powerful scenarios that we can look at that might help the market to go up. And they're called the possible positive scenarios. Then I realize the danger when we assume, okay? I know the old trick where it can make an ass out of you and me if I assume that you know these things when really you don't. And you might just take part of what I say and go, well, this guy doesn't know what he's talking about. Or you may go, I have my own philosophy and that's worked for me. Good, that's great. And if you've done that, please contact me. I like to talk to successful people that participate in the market. First of all, before I get really going into this, I want to send out a heartfelt thank you, as I've attempted to figure out a plausible explanation for what's happening right now in the market. The bigger picture finally came together for me after I watched a video on YouTube that was posted May 21st, 2022, and I have no idea how to pronounce this, by Ciovacco Capital. I don't know, I'm possibly butchering that name. You can view this yourself, and I viewed it on May 24th, 2022. Right here is the link, and I'll also put that in the description below. It's well worth watching. Some of you that already watch my videos know that this is a channel that I recommend on my YouTube channel, but some of you said you really like these videos. Others say, no, you don't really like them. I'll just let you determine if you think that's useful to you or not. Ciovacco Capital, and I have no idea if I'm saying that right. They post videos every week on YouTube, which I recommend that you view on a regular basis. I have no connection or relationship. Obviously, I can't even say their name, but I'm indebted to the useful weekly videos that they do post on their YouTube channel. This is what their channel looks like. I just went and took a screenshot. So I'm not taking full credit for all of this. Some of this I was putting together, but it was by watching a video at this YouTube channel that helped me put it all together in a way that I feel I could present to you. So the bigger picture, what are we looking at here? 2022 has proven to be a very challenging time. I've been following the markets for almost 3 decades, and this has been one of the most challenging time periods that I've ever seen. It's not just because prices have been declining. It's pretty easy to determine when we're going down, when we're going up. It's because the signals that we really rely on, that I've used for decades, they have often proven to lack significant price action follow-through. What I'm basically saying is I have a lot of different signals that I look at, and I say, okay, the market should go up from here, or it should go down, or it should go sideways. And it might do that for 1 or 2 days, and then it just turns and goes the other way. And that can be very frustrating. And you get this choppy sideways market that we pretty much have been seeing for 2022. The trend is pretty easy to follow. When the market's going up, everybody's a genius. You buy low and you sell high. If you participate to the downside, that's pretty easy to spot too. You just sell high and buy low. Choppy markets are harder to navigate, and they often lead to a lot of false breakouts as well as whipsaws, and that's what we've been seeing a lot of. Just for example, last March, in the middle of March, we had some really good signals. We ended up going up really strong, one of the stronger up moves that I've seen in just a week-long period. But people didn't believe it, and about the time they started to believe, hey, maybe this is for real, and they got in, that ended up being the top. And then we really declined after that. And so they're like, oh, forget this market stuff. It's just crazy. I can't do it. So this is what we've seen also for most of 2022. There's another thing called Fed Fixation. That's what I'm calling this right now. It says no matter how many positive setups we've seen in 2022, each has broken down and led to lower prices. And I'm trying to answer why. Why has that happened? Why are we seeing a different market environment in 2022 than what we saw in 2020, even after the COVID plunge, and especially what we saw in 2021? Why are things different now? Yes, a lot of things have changed since 2021, and we can read into that. But a lot of things that we depended on in 2021 to help us make decisions, they're not working all that well in 2022. The reason for that is the Fed. As the economy changes and goes through the different cycles, the markets, as they should be, are fixated on the Fed. Now, you may hate the Fed. You may think the Fed is the worst thing in the world. You may think the Fed was sent from heaven itself and it's the greatest thing to ever happen to the U.S. economy. I don't care about that. What I'm talking about is real-time results, what we're really looking at. The Fed is a reality. The stock market is a reality. They're both there, and so we need to find a way to find information based on what the Fed is doing. And we tend to fixate on what the Fed actions are. This is due to rising interest rates and growth concerns. We've seen a real shift. Where in 2020, 2021, they were worried about having any kind of economic growth at all. Then they changed things, and it got to the point where now they've overdone it, and we're seeing rising interest rates and growth concerns. So the premise that I'm making in this video is until there is a major positive shift in Fed policy, it will be very difficult for the markets to move significantly higher. Now, I may have the answer to that. We may have already received the answer to that, but at the time I started preparing this, we weren't quite sure. The Fed's balancing act. The backdrop for this very difficult time on a very big level or a macro basis, it sits mainly with the Fed. We are in a Fed-induced market for 2022. The economy is experiencing high inflation that's been brought on by the reaction to the COVID-19 pandemic. Probably all of you are aware of the monetary policy that the Fed enacted. They immediately took the Fed funds rate down to 0 to try to stimulate the economy. Massive quantitative easing programs. We saw this after the financial meltdown in 2007 into 2008. something the Fed said they would never do. Well, they did do it, and now it's become, why doesn't the Fed do this? It's become more accepted, where basically they print money out of thin air and then use that money, they buy bonds, and then some of that money makes its way over to the stock market and has really been the reason why we've seen this explosive growth for the last 2 years. Well, that's starting to stop now. And so this big amount of energy that has been pushing the markets higher is starting to go away now. Also, fiscal policy. These are things that have been enacted by Congress or through executive orders by the president. This can include the stimulus checks and other actions that were set up to assist citizens and businesses during a very difficult economic period. And then shutting down the economy. We all got locked down. We're also facing a slowing economy now, as evidenced by numerous economic reports. So what happens because of all this? What is the fallout here? This has produced a potential no-win situation. In 2022, the Fed must raise interest rates to fight high inflation, okay? And they're doing that right now, while simultaneously attempting not to slow the economy down too much and throw us into a recession. That is almost an impossible task. With so many variables in the U.S. economy, it's really hard to do that. It's noble. It's something worth trying, but to actually have it achieve that is pretty much impossible. What we're afraid of is a recession, and a recession is defined as 2 subsequent quarters, so 6 months back to back, of negative GDP. We've already seen where we might be getting 1 quarter already. Are we going to get that second quarter? We don't know that yet. If we do, and that's the final result, we would then be in a recession. The other thing that the Fed is worried about is a thing called stagflation, and if any of you grew up in the 70s, you know what this is. There's a real risk that we might experience this. Stagflation is a period of very high inflation, coupled with little, no, or even negative economic growth. So we have really, really high interest rates, really, really high inflation, but the GDP is negative at the same time. And that is a really difficult situation to navigate through. Well, the markets have tried to figure out what is happening every day. Prices have floundered. One day it's like, okay, we're all happy and we're going to go up. Now we're going to be depressed here and we're going to go down. After hitting that all-time high in January 2022, we've been just bouncing all over the place, and we're almost halfway through 2022 as I record this. Prior to the release of the minutes that came out on May 25th and their follow-up conclusions that have happened that I'm going to talk about, there was no sustainable or longer-term actionable policy. It's like, what are they going to do? We need the Fed to come up with something, but they may have done that, and it may have been in the past week, leading with the Fed minutes coming out on Wednesday, May 25th. In absence of that, it was going to be really hard for the markets to take any action. And it results in a trading range like what we've seen so far this year. When faced with lots of uncertainty, what would you do? What are you doing? If you've got 10, 20, 50, 100 grand on the line, and you want to put that to use and make a return on it, are you going to stick it in the market right now when you're like, well, we might go crashing down from here? I mean, multiply that by all the different money managers out there and all the different investors who are going through real fear right now, not knowing what to do. So what do? You sell what you have, maybe at a good point. You stay in cash. You might get into safer investments, and I have that in quotes because what's safer right now? Bonds? They're returning nothing. Cryptos? They're crashing. Gold, it's doing nothing. Forex, the dollar's been doing well, but there's really no good area right now. It may pan out in the future, but I'm talking about a safe place right now. But people still do this. It's like, I'd rather lose 8 or 10% than 30 or 40%. And that makes sense, and I can understand that. That's called more of a risk off, when you're getting out of stocks and putting into safer investments, especially bonds. There's also a thing called the Fed put. The Fed put is really just a play on words. If you trade options at all, a put option is something that you can buy through an exchange that increases in value as either a security, let's say a stock, or an index, let's say the S&P 500, declines. And so people often use this as protection. And I teach this. Why would you own stocks without putting protection on it? You should always be implementing this. Yeah, it can bite into your returns when we're going up, but it can sure save you when we're going down. And if you don't watch the markets really closely, you don't know when that's going to happen. This was initially developed, this term, under Fed Chair Ellen Greenspan. When the stock market was experiencing really significant declines, like in the 90s, Fed policy would often be modified to help produce a positive environment for stocks to go up. And this became known as the Greenspan put. Don't worry, the Fed is here. We're going to change something around and the market's going to shoot up higher. Since he retired, this has been implemented by subsequent Fed chairpersons. Bernanke, Yellen, Powell. They have been implementing such tools. And so now it's become known as the Fed put instead of the Greenspan put. For all of 2022, I'm going to tell you my personal bigger picture view. I am not a doom and gloomer. I am not the ultimate optimist. I try to present myself as a realist. There are times when the market goes up, and that's the majority of the time. There are times when the market goes down. Fortunately, it's not as much, but it can do an awful lot of damage. And there is a significant period of time when the markets go sideways. Instead of just sticking my head in the sand and saying, well, we'll just hope for the best, let's try to take advantage of that. And so I've developed my view for what I think is going to happen. Now, I could be wrong, but I've had this view since about late fall of 2021. And so far, it hasn't changed. It's drawn out a bit longer than I thought it would, but the overall scenario has not changed. First of all, a decline from the all-time high that leads to a significant pullback. Duh, that's what's been happening. So it's happening now, but it may be ending. As I was preparing this video, it wasn't ending. Over Memorial Day weekend of 2022, we had a couple of really good days on Thursday and Friday, and it may be ending. I'm not saying it is, but some things are lining up right now which may be helping things. Number two, once we put in a solid bottom, then we have a strong uptrend, possibly to new all-time highs. We might not get all the way back up to the old all-time high set earlier in January. We might even go above that. So that's part two of my scenario. That hasn't happened yet. Or has it started now? There's been a number of false starts in 2022 where we thought it might have been starting, then it flopped. It ran out of steam and we ended up going back down. The third part is, this is what might cause you some concern. Once that's completed, once we go up at some point, we either get close to the all-time high or put in a new all-time high. Once that's over, and I may reevaluate things at that time. This is just how I see things right now. There will be a severe multi-year bear market that will take the markets significantly lower. I'm not saying that as a doom and gloomer. I'm not saying that as an Elliott wave counter who's been counting the fifth wave down for 20 plus years. I'm saying this out of pure reality, out of what I see happening economically and in the markets. I could change that though. We're waiting for that to happen, or has that started? There's a lot of people that think we're already headed lower and that this significant decline, it's here. And this bounce that we've been seeing is just a dead cat bounce, and we're just going to wear that off and go lower. And that may be what happens. We have to be open to what's actually happening right now. What I'm going to do is I'm going to look back in history, not too long, just about 10, 11 years. That's where I'll start. And then I'll go up to the present day. So what I'll do is I'll look at 4 historical cases and 1 current case. I'll examine that in which the market was heading lower, showing really oversold conditions like what we were seeing earlier in the week, like what we've seen many times throughout 2022, but still needed one more catalyst in order for a real significant rebound to occur. The first one will be back in 2011. Then we'll look at 2016, 2018, 2020, and then 2022 with a question mark because we don't know. You really only know the answer to these things in hindsight. But the idea with what I teach and my approach to the markets is to develop foresight. See things that are going to happen. You're not always going to be right. The scenario that you come up with for tomorrow is not always going to be exactly the way you say. You can adapt, you can change, you can modify things. Just walking in blindly, that seems to me to have a lot more risk attached to it. The first one is called the European debt crisis, and some of you may not have even known this happened. This was back in 2011. The markets had been advancing from the low that we set in 2009 after the financial crisis. However, back in 2010 and into 2011, there was this situation that developed in Europe which caused a lot of turmoil, even in the U.S. markets. We're not an island in and of ourselves. If something happens in Europe or even in Japan, that can impact the U.S. markets. We had oversold indications. It suggested that we wanted to go higher, but the market just didn't want to. However, there was one thing lacking that really needed to happen: a catalyst from the Fed. It happened on October 4th, 2011. Here is a screenshot, and I took this from the CCM YouTube website. This is a screenshot from their video where it says Europe Factor shares, that's what they call their stock market there, seen snapping 3-session losing streak. Belgium, and I don't even know how to say this, Letterm says bad bank will be set up for Dexia. What in the world does that mean? Look down here in the red box. A bad bank for troubled assets will be set up for Dexia SA and will have government guarantees. Belgium Prime Minister blah blah said. BBC said Belgium approves bad bank for bad assets. Whether this is good or bad is irrelevant. Whether it's moral or immoral is irrelevant. The market used this as a way to really shoot higher after that. And I'll have a chart to prove all this to you later on. Another thing that happened back in 2016, the markets were really declining. We had oversold conditions that went unheeded, and it looked like we might even head lower from here. Ta-da-ta-da! The Fed provided a pivot that allowed for a significant recovery. This is it. Janet Yellen came out and said on February 11th, she was willing to undertake the idea of negative interest rates. That hasn't happened. That never has happened. Yes, the 3-month went negative there for a while after the COVID plunge. We've never actually done negative interest rates. They did in Germany for a number of years. They have done this in Japan. We've never actually undertaken this in the US. But just the idea that the Fed would be open to that produced a really nice bounce. Looking at the bottom, Ms. Yellen conceded this risk on Thursday when she said the Fed is studying the feasibility of following Europe and Japan into negative interest rate territory. Even if you don't understand what that means, this is a shift in Fed policy, and the markets just shot up after that. All right, let's look at the next one. This is called a balance sheet walkback. Ooh, what does that mean? Well, this happened in 2018, and in late 2018, the markets were really going down. We ended up having what I call the Christmas Eve mini crash. That was so interesting to watch. The markets are closing early for Christmas, and it just keeps going down and down and down and down and down. And it's one of the most severe declines you've seen. It's, of course, on lower volume because a lot of people are home celebrating with their families. They weren't there to really keep an eye on the market, and it just kept going and going and going. We developed into oversold conditions, and there was a lot of confusion. What's going on here? There's no Christmas cheer coming around for us. Well, in early 2019, so there's a little bit of a delay here, the Fed provided a pivot that allowed for significant recovery. What was causing a lot of the concern is the Fed balance sheet was really expanding during that time because of quantitative easing way back from 2008. And they kept saying, we're going to start selling this stuff. We're going to start to lower our balance sheet. And it wasn't really happening the way the markets really like that. So that was really producing a negative background. Well, here, according to CNBC, Fed Chief Powell gave the markets the message they wanted. And notice over here, this was 5 to 6 days later. We had the crash on Christmas Eve. It wasn't until everybody celebrated New Year's, came back to work before this really started to kick in. And they made an announcement that they were going to walk back some of the things that they had said before about how they're handling the Fed balance sheet. And this just sent stocks really higher. Then we have the COVID plunge in 2020. As the markets were declining in early 2020, it seemed like there was no bottom in sight. They were just going down and down. All the doom and gloomers were just partying and saying, this is the end of the world. We've said this all along, even though we missed all these up moves. Now we're finally going to be right. The Fed made an announcement that allowed for a V-shaped bounce recovery, which continued pretty much up until January of 2022. We're out of that range now, and that's why we're in a different environment. Here it is. The Fed announces unlimited QE, quantitative easing, and sets up several new lending programs. Bloomberg said Fed unleashes unprecedented measures to shore up reeling economy. Even if you think this is as immoral as it gets, even if you think this is dangerous, bad policy, dangerous economics, the market liked it anyway. And that came in March of 2020. In fact, March 23rd of 2020. Isn't that about when we saw the bottom of the COVID plunge? Yeah. All right, did it happen? Now what we're talking about is what is currently going on at the time I record this video. For the week of May 23rd through the 27th, this is Memorial Weekend as I record this, there were two key events that may have served, and I have to say may have because we can't be real dogmatic about this, to provide the necessary catalyst. Number one, the minutes came out last Wednesday. They were released, which suggested the possibility of slowing down or even pausing rate hikes. Ooh, we haven't heard that in quite a while. That's how the market interpreted this. The second thing is, we've been seeing some weakness in our economic reports lately. A few weeks ago, there was this scenario that developed that maybe we're going to peak in inflation. And I'm like, okay, yeah, show me. Well, we're starting to see that, where inflation, it's still high, but maybe we're starting to come down now. And so these two events, when you take them together, may have provided, and I have to say may have, because we're in the middle of this playing out right now, this could be seen by giving the market the possibility of having strong advances after the FOMC minutes were released on Wednesday, May 25th. We saw a nice bounce on Wednesday. We saw a really nice bounce on Thursday. We saw a really nice bounce on Friday of this last week. Here is what we're seeing. Fed rate hike pause in September may make sense, Bostic says. Well, he's an Atlanta Fed leader, and he supports this idea that we might lay off of raising interest rates. Also, Reuters came out with Fed may pause policy tightening in September, Bank of America says. The market likes that kind of stuff. Whether you think it's good or bad is irrelevant. Other things, the dollar bulls are on ice. The dollar had been going up really well. Well, over the last week, it's been getting hammered. So that dollar bull is on ice as bets for Fed pause on rate hikes gathers pace. And this came out on the 24th. And then on Friday, the 27th, dollar slides for second week as traders adjust Fed rate hike views. This might be what the markets have been looking for. Here is a chart to kind of bring it out of what happened this past week. This is a 10-minute intraday chart, and I go through this every day on the daily videos that I do. This is back to Monday, where I'm at right here, and it was kind of, we chopped a little bit on Monday. We were down, came back up on Tuesday. We were pretty slow on Wednesday. Right here where I have the arrow, that's when the Fed minutes were released. Ever since then, we gyrated right after they came out, but we've seen a really nice advance. Can this continue? Here is the chart going back historically. Here is the low that we set back in 2009. The first instance in 2011, this was Tuesday, October 4th, 2011. This is when that Fed policy shift happened, or the Fed pivot happened. We didn't go straight up, but we sure put in a significant low here. The second case that I look at is Thursday, February 11th, 2016. Looking like the stock market was just going to go down and down and down. The Fed policy came out with a shift, and we saw a really nice advance after that. Friday, January 4th, and this is after the Christmas Eve crash. Everybody comes back after the holidays. There seems to be a shift in Fed policy, and we see a really nice run up after that. Here is when they unleashed unlimited QE, March 23rd, 2020. This is where we're at, way up in the right now. I have a question mark because we don't really know what's going to happen. This was Wednesday, May 25th, 2022. We've been bouncing the last few days. Are we going to get some legs behind this and be able to go higher? Another thing to take into account here is that at the next meeting in the middle of June, there's a 93.3% chance that we're going to be at 1.25 to 1.5 after that meeting. And that's pretty much what it has been all along. Then there's another meeting in July where there's almost a 90% chance that we'll be at 1.75 to 2%. That hasn't changed all that much. There's been a few little blips here and there. What we're really looking at now is September. Do you see where these are kind of evening out here? They're not as sure about things. Now, that is farther into the future. I watch these things every day. I usually report on them in the weekly videos. As we get closer to the FOMC meetings, then I start talking about them every day. Because to follow them and try to get all crazy about them now really doesn't do you any good, because a week from now it might be totally different. So, personal perspective. It's beyond the scope of the intentions of this video to say whether the Fed pivot points were good or bad. I'm not saying what the Fed did was righteous or evil. That's not the goal here. The fact is that they happened and they had a positive impact on the stock market. When analyzing the current scenarios and the conditions that we're in right now, it's often necessary to disregard any personal assumptions or biases. Some of you who are kind of new to the markets, maybe you've heard that 80, 90, 99% of all new investors fail. It can often be attributed to this. This isn't the only reason, but when people bring their own opinions, their own assumptions, they don't let the market tell them what's going on. They bring what they think the market is saying, and then they fit everything to try to justify the conclusion that they've already made. And that's why a lot of traders and investors end up losing and are no longer participating. It's a normal human condition. But to be successful, we need to try to find ways to overcome this. The idea is to understand what's happening and why, not if it's good or bad. The U.S. stock market is amoral. The stock market's not out to get you. It's neither good or bad, nor does it owe you anything. It's just doing what it was designed to do. It's like saying, every time I go to a ball game, my team loses. You're not the center of the universe. Just like every time you get into the stock market and your stock goes down, you're not the center of the universe. It's not out to get you. You don't have that much pull on all the forces in the universe. Sometimes we kind of have to get over ourselves when it comes to the stock market. And this might be one of those things that will help you. Our goal is to see what is happening and then move to take advantage of what's happening right now. And then these scenarios that I'm talking about to experience greater understanding and, yes, result in higher returns. That's what we're trying to do here. If you can earn 20% instead of 3%, if you can earn 18% instead of 9%, don't you owe it to yourself to do that? The conclusion that I've reached here, at the time this video is being prepared, it's Sunday, May 29th, right in the middle of Memorial Weekend. The markets had been exhibiting excessive negativity, extreme fear, and an oversold condition. In technical analysis terms, it's due for a bounce. However, to see a bounce that lasts more than just 1 or 2 days, and that's what we're trying to figure out right now. The bounce that we saw on Thursday and Friday. Is it only going to last for a couple of days? And then when everybody comes back after their barbecues and their beach trips, are we going to head down after that? So it's been imperative for the Fed to announce something if they want to help the markets stay higher. And it's in their best interest to do so. There's a lot of people with a lot of money that when we go down, they lose. And I'm not talking about individual investors. I'm talking about politicians and very wealthy people that put pressure in the markets. Life is just better when the market goes up. But going down is just what happens. What I'm looking at right now is that possibly what happened during the week of May 23rd through the 27th, that was the pivot point that was needed. When I first started preparing this video, I hadn't put this all together yet. That's why I wanted to wait a few days. And I discuss this in the videos that I update every day. And I might be wrong. Take it for what it's worth. But at least owe it to yourself to try to understand what I'm saying here and see if this fits in to your overall decision-making process. So if this is not correct, the choppy environment that we've been witnessing, it's going to continue until something happens, usually in a Fed kind of way, to shift things to a more positive environment. When we know we're in a bear market, I'm just going to throw this out there, is when the Fed makes a shift and the market still doesn't care. It's still going to keep going lower anyway. I don't think we're there yet, but we might be there not too far into the future. So thank you very much for indulging me in this. I hope you found this helpful. Please let me know. And I post these kinds of videos periodically in addition to the regular videos. So thank you.